Good afternoon, everyone. Brett Crowther. Good to be back with you. I apologize for that last week. I had some things come up and I wasn't able to be here at the classes that day. But it is good to be with you today as we're going to go out and look at what happened to the trade we put on 2 weeks ago, where things, how has it been performing, and what kind of modifications we may need to make for that. And I want to talk specifically about just managing trades. We've done a lot of that in the recent weeks, but it's something that, especially with these spread trades, it's not as you can't quite put it in a box and just say, okay, set it and forget it type stuff, or just put it in there and put the stop loss and walk away. I mean, you can, let's be real, you can, but there's a lot of ways that they can be managed, so we ought to be understanding of some of those different ways. So we'll look at that. And then also what I really want to spend today on is just going through, I have a list of stocks, and we don't have a lot of trades going on in this class. And so I'd like to just add several paper trades and get a kind of a portfolio built. And so hopefully we'll spend a majority of the time just going through some stocks, and we'll see how that plays out and how many we have time to do. But before we get there, let me just cover some disclosures. So do remember, the options do carry a high level of risk, not suitable for all investors. Information we cover is for general information purposes only, should not be considered an individualized recommendation. For the sake of simplicity, examples are in this presentation do not take into consideration commissions and other things. Paper money is for educational purposes only. Short options can be assigned at any time. Something really important to understand. It doesn't matter whether it's out of the money. It can be assigned at any time. Investing has risk, including loss of principal. Past performance not guaranteed of future performance. And then here are some disclosures and also some descriptions of the option Greeks and stuff. Do you know that a stop loss order does not guarantee that it will be executed at that price? That can come up from time to time, so keep an eye on that. All right. So with that said, let's jump out and take a look at, first off, the overall market. It's been kind of interesting as, you hear so much kind of almost doom and gloom at times, and you think, okay, what's really going on? And the market itself, even since we've talked, I think what was it, 14 days ago, was that the 8th that we talked? So we're talking somewhere in here. I mean, it rallied up, it dropped down, and rallied back up, right? But it's just still overall has been kind of trending higher, It really hasn't made lower lows or lower highs. The overall moving average that we have on here, I have a 50-period moving average. Moving average, but just sitting, heading higher. And so overall, it still has this upward trend to it. Now, the SPX is probably, in fact, we pull this up, the SPX is probably the weakest of the indices, right? If I were to pull up a comparison chart, and this one just puts all four of the indices, you got the S&P 500, the NASDAQ, the Dow, and the RUT all together, right? And right here, this one right here is actually the RUT. The RUT is taking off those small caps, are doing very well. Now, this only goes back. You should always make note of when you put a comparison chart together. I'm not going to go through just setting up the comparison chart today, but when you put a comparison chart together, it compares it to whatever time frame you have. And so this one is only going back, it's like a year-to-date comparison. So we're looking at about 3 weeks worth of data, right? And that could vary. If I change this, in fact, I'll do that here in a minute. I'll change it to a little bit longer, and you'll see how that'll change it. But then I believe we have the Dow right here, then the NASDAQ. And if you ever wonder, you can always, pop it up and then see what it says. NDX or NASDAQ, and then we have the S&P 500 right there. And if I look at this, I was mentioning the different time frames will play a role in how this plays out. And so again, this is like a year to date, 1 day, right? If I were to go to a 1 year daily, though, that will change. You can see, okay, well, now we've had a couple different things. Like, relatively speaking, we saw the RUT drop down, and then it's, kind of climbed up more so than the others, right? So it dipped down a little bit more, but also ran up higher. And then we have the NDX, not nearly as, it hasn't fallen, or should I say it's a little bit tighter race between the RUT and the NDX than it showed on that year to date. So it's really, over the last 3 weeks where we've really seen a lot of separation between those and the RUT take off. But either way, if we were looking across the board, in fact, let me just go back to our basic charts here so you can see like this. If we go back to like the NDX and stuff, all of them all of them are still, making somewhat higher highs and higher lows. Some are a little bit stronger than others, and you see a lot of the indicators possibly winding up, which some would say be concerned about that saying it's lower, but also look at this, the lows are getting higher. And so it's maybe the fact that it's on an uptrend, it's kind of a weakening uptrend that could be a concern, but we have to remember that it's still in place. The trend is still there. It's still up until it changes, and it hasn't changed. And sometimes, remember, they can run up, they can go sideways, and then take a breather, and then run up some more from there. And so just remember, just because it's going sideways or slowing down doesn't mean it has to turn down. It just means, hey, it's just losing some of the bullish momentum. All right. Okay, so overall markets are still up. So let's do this, and I got to kind of set the stage for this. So we placed this trade on Meta about 2 weeks ago, and I watch it every day, and I think about, hey, what am I going to be talking about in our class and how it's going to be applicable and all that stuff. Well, the trade. In fact, let me pull up the chart real quick to show you on that. This is going to be interesting. Not METS, MET. Let me type it in there correctly. There we go. All right. So this is essentially what we were looking for. If you recall, it had a gap down, which creates an area of resistance, right? Drop down, right back up, hit that area of resistance. And this is so much psychology that plays out on this. I was actually talking to someone last night about as we were talking trades and stuff. They were asking, like, why does it tend to roll over there? I said, well, think about it. People are up here thinking, hey, they buy it at 750, 760, thinking, hey, I'm going to make money. And then it, gaps open the next morning, and now it's at 720. And they're like, wow, I just lost, or 670. I just lost, what, $70 or so. And then they think, you know what, forget the going higher, forget the 800-900 that I was thinking. If I can just get back to where I was up here around 750, I'll get out, right? So from 673, what happens there? Well, it drops down. And now what tends to happen a lot in some minds is that they're no longer thinking, wow, if it could just get back up to the 750, 760, they say, well, if I could just get back to where my losses were a little bit less, right? Up here in the 670 area. And so then they kind of ride it out. And when it gets back up there, now they're like, wow, now I could get back out, or I could get out back where it was bad, but not as bad, right? Where I was thinking here, I'd hold on, let it rally. And so, it's kind of people cut their losses at that point and get out. And so it can create, it doesn't have to, it just depends on how many people are on board with that kind of thinking, which, is not uncommon. This is why you have those price patterns like a dead cat bounce. And it tends to roll over, and you can see it actually rolled over and dipped back down and then rolled over again. And that's when we caught it. And so over in here, I think that's the 8th right there, is when we caught it as it had dipped down from that resistance. And so we hopped in the trade. It's kind of small in here. Let's edit this and bring this up a little bit. Let's make that just a little bit larger. Change the font size maybe to a 12. I don't want to get too large, and then it takes over everything. But let's bring this up so we can see it. So what we did at that time is we sold 3 contracts of the 675, 680 put. And so right around here is that 675. And so really, remember, we need to have it below that level at expiration. And this was a February 20th expiration. And so, just writing that out. Well, here's the deal, is when we entered that trade, the price action went our direction, fairly strongly our direction. It would have been nice to get a little bit closer to this old low in here, but hey, it moved our direction. And so I was watching this. And so let's go over and look at it right now. Let's check this out. It's still profitable. It is still profitable. Then hold on, I'll get to the comments here in just a second. So it is still profitable. However, look at today, $217 down. Now, has a trade, is it lost? No, I mean, there's still time, right? We still have what, 40, there's 41 days till expiration. I think there's 29 now. Yeah, about 29, because there's 41 when we got in. There's 29 days till expiration. So there's still plenty of time for this to play out. There's still a lot of time decay in there and whatnot. But here's what I want to stress, and this is why I want to say it's not always this, if you place a trade and all of a sudden you can get, you set your stop for 80% gain and call it good no matter what. Just wait for that to happen, or I guess you're exited. That it just you let that play out. So here's a situation where we place this trade in about 9 days into it, 9 out of 41 days, mind you. So we're not even a quarter of the way through that time frame that it was allotted. It was a little over $300 in profit. And so the total profit on that trade is a little over $500. And so basically, we wrapped up 60% of the profit at that time in 9 days. So, here's a thought. Do you wait? Do you wait 75% of the time more to gain that other, you know, 30-40% of the profit? And the other challenge on that is you know, we don't always get 100% of the profit, right? Because depending on where that price action is, as we get close to expiration, if that price is getting close to the strike price, if the stock price is close to the strike price, we're probably going to close out before expiration. A lot of times we tend to just to close out that trade, just make sure nothing happens at the very end, which we've seen that. I've held on some trades in this very class to show you, so I could exit during the class to show you, just the transaction, how to go through it all. But right before expiration, it pops, and we think, this trade that we had it all wrapped up, all of a sudden becomes a loser. And so, it's not a bad idea to manage those winners and get out when you got a good spot. We've collected most of the premium and all that jazz. And so anyhow, hopefully you can see what I'm talking about here. That if all of a sudden we get in a trade and it makes a significant amount, a huge portion of the profit, and there's still a ton of time left, that might be a time to exit the trade. And so that's what I wanted to do. I was going to hold on here and think, oh, hey, if it drops a little bit more, I'll show the class. We'll get out today, and bam, this is what happens. So what are we learning from this? It's like almost every time that on a Thursday, something happens to whatever trade that we have in as a class, right? That's the crazy thing. That's what we're learning. But still, this trade itself hasn't gone south. I mean, it needs to be below this by February 20th, and so it's still there. It just, unfortunately, we're not able to. We are able to. I just don't want to pull off the trade now, with like a $20 profit when there's still nothing wrong. And it might even come back up and give a little bit of a retest and come back down. We'll have to just wait and see what happens. But this is since we didn't take it off, when there was an opportunity down there to collect most of the profits. Be patient, wait for it to roll back over. Okay, I want to just see if there's a comment in here. If the trade goes against us, which is to say 30 to 40 days till expiration, when should we get out after opening, looking at the loss percentage? Okay, so now, I guess if I'm understanding the question correctly, it says, okay, if we hop in the trade and it goes against us, right? And this is an interesting question. And here's another thing. It's not just like, okay, well, here's if it breaks resistance, exit no matter what, right? I'd love to have some sort of a comment like that. But the thing about it is, it's really hard to just prescribe something that fits every single scenario, right? And so the question is like, well, what if it breaks resistance? How far does it break resistance? Does it, like, if it had a candle that, let me grab a drawing tool in here. If it has a candle, let me actually remove some of this drawing right here, and then we'll do this. If it had a candle that were to break resistance and it did it, I gotta get a smaller. That's a little bit too fat, isn't it? Let's try this one more time. If a candle were to be like this, really long, right, where it goes way up and it's all bullish, very little wick or something, that's a different story than if we had a candle that broke resistance. But you know what? Maybe it just barely broke it. And, maybe during the day it ran way up. And so this creates a little different scenario of like during the day it ran way up and came back down, which suggests that the bulls were not able to hang on to the high. It came back down. Now, both of these scenarios have broke the resistance, but I hope you can understand and see they're completely different scenarios here. One is extremely bullish. The other one showed actually the bulls weren't able to do that well. And, maybe give it another day and see, because then the next day, if it comes back down, then it's okay to ride that one out. And so this is what I'm saying. Like, people will say often in stop losses, set a stop loss on your stock like 3% below support or 5% below support or something like that, right? Which, there's always a good baseline to go from. But what I want you to understand is the general rule is, okay, if it breaks resistance, that would be the potential to get out, as a kind of a general rule. However, let's look a little bit deeper and say, okay, but are there any other extenuating circumstances? Like how badly did it break? Was there strong volume? What else is going on? Is this something in the market that's taking everything up, or is it just something that's kind of flash in the pan for the stock? That we want to weigh all those things in consideration. And the problem with what I'm saying here is it sounds like it makes it more confusing. It makes it more challenging. But really what it should be doing is enlightening you to understand this is why not just everyone trades and just makes a ton of money on it. There's lots of different ways this can be interpreted and ways to look at, the strength of a move. And so it should make you a better trader if you understand kind of the nuances that can happen out there. Let's see. That was a quandary. Do I stay? Okay. Do I stay or do I go? Sounds like a song, right? Should I stay or should I go now? We made a pretty good profit. It is a quandary. And relatively speaking, kind of as a general concept, right? One of the things is, again, if we can pull off most of the money in a fraction of the time, we'll look to pull it off. Other than that, we'll be patient, right? Because a lot of times if it's just kind of like rolling along, it's okay, it's just doing its thing, then we got to be patient. And that is something that's very important on these spread trades, is just being able to sit and almost wait for that money to accumulate over time. It can take a while. And then obviously as it gets close to expiration, then start to watch it more carefully, because now is kind of do or die. And we've covered in this class also in previous sessions, just the way, you might get some of that gamma risk that comes up that can change that delta. You might look at the delta and think, okay, according to that, we're in a pretty good spot. But then all of a sudden that delta changes dramatically. There are all kinds of things that can happen like that. And so you just got to keep a closer eye on it as it gets to expiration. Right? Good. I'm glad that helped out. All right. Rice, Bird, Will, others. Hey, Sandip. Yeah, good to see you all. It's good to see you all here. I love having you all here. All right, let's see. So I want to cover the meta. Let's talk about some other things going on out there. In fact, let's look at this. The VIX was kind of interesting. Here's another thing: is I would have liked to have. Again, I don't know what is with this Thursday class, but the VIX jumped up. I thought, hey, it's going to be great to talk about spread trades while we have a climbing volatility, right? And then of course, last 2 days it's dropped down and volatility is down. So overall, that's kind of a little bit of a damper on some of the premiums. And of course, every stock has its own volatility, right? But just generally speaking, when the market volatility is up, then those premiums tend to be just a little bit juicier across the board. It makes it just a little bit easier to find, trades that have, solid premiums in them. But that's okay. We'll still find some. So what I do is I, kind of basically go through and just look at stocks that you may have a list for whatever reason. One list, it's unfortunate we have like the rut is moving so well, but one of the challenges with the rut and something like these spread trades is, those smaller stocks with more thinly traded stocks don't tend to have great option bid-ask spreads, right? They're a little bit more loose, and so it doesn't lend to possibly, even though the chart might be setting up, the options become, the bid-ask spread is just too wide to make it really work or feel comfortable with. You see, bid-ask spread, it's like, a $4 and a $6. It just makes it tough. So it tends to be, a lot of those stocks I'm looking at for potential trades here, example trades, is really something that has high volume, really tighten those bid-ask spreads. And so it becomes kind of the major, larger stocks that more people are familiar with. And so I put a lot of those in a watch list. And I didn't have any sort of a fundamental criteria or anything like that, but just really looking at what are the option premiums looking like? Do they tend to be tight, right? But going through that list, so scan through the list, and there's a couple of them I want to talk about. And so let's look at a few of them that came out as I went through there. Now we played this one before. We've looked at this. You can see we even have this enter to short call back here. We've made a trade on Adobe, and just looking at Adobe, it has some interesting things. I have this line right here, which is a support level, and you'll see it goes back off the chart. Now, why is because if we look back at a 3-year chart, you can see that was support several years ago. This is a 3-year weekly chart. It came down, bounced off that, rallied up, it came down pretty close and bounced again. Kind of had that near bounce. Somewhere in this ballpark is quite a bit of support for Adobe, and I thought that was important to kind of point out for this shorter time frame. Because now as we look at it, let's extend this out a little bit. So let's activate that and pull that out. What's happened to Adobe? Well, look at that. It's gone through it, right? And so this one is one that maybe not right to set up a trade at this moment, but one to keep an eye on, because what we're looking for obviously is something close to resistance or support area, right? Like it's just recently bouncing off of one or the other, where we just kind of have that as a guard, a gate to just protect us against price action coming in and crossing that line, right? It just gives us a line in the sand to just feel comfortable, and hopefully it's more than a line in the sand. Hopefully it's it's a nice cement wall going up, saying, okay, turn around and go the other direction. One thing I like to do, in fact, let me zoom in on this from a technical standpoint, is also run those Fibonacci's that I've shown you several times in this class. And so I'm going to grab my Fibonacci retracements right here and run it from this resistance. So I hope everyone can see we have a bit of resistance right about here, right? Oh, now I want to fatten that back up. I had to make that thinner to show some things earlier, but right here is some resistance, and you can see it drop down. This is a little bit of a hiccup, but really the move itself, as I see it, is coming all the way down here, and this is a support level that is starting to bounce and bounce back up from. And I think this is a really good teaching opportunity to illustrate that. In fact, let me go back and show this day by day, because people always wonder, okay, when can I draw something like a Fibonacci? Well, this is continuing to come down. And, someone will say, well, could have you drawn a Fibonacci between here and here? The answer is yes and no. Can we? Yes. But look at what happens when we do. It's like the price levels are so tight that it almost makes no sense, right? It's like it's going to hit all three at once. So you need enough of a distance between it that there's actually room to draw. And so just keep that in mind. But so it keeps coming down, and now we have just kind of going sideways here, and now you can see it's starting to potentially rally back up, but it's giving us that, okay, we're off a low. Hope everyone sees that. So let's draw this from this high down to that low down there, and we'll pull this back over. Now, interestingly enough, check this out. Interestingly enough, this 38.2% retracement, so from this low is coming back up as a 38% retracement off that low. It happens to line up directly with that long-term, that multiple year support level that we drew on a little bit earlier, right? And so that would be one that kind of combining support levels, which should now potentially act as resistance levels, is a spot we'll keep an eye on. So like one of those homework assignments, we'll keep an eye on this one. We'll watch for that to rally back up, potentially roll over when it gets up to this area up around 300. What is that? 316-ish? Yes, it's somewhere around $316. Okay. All right. So a good one to talk about Fibonacci's and stuff. Let's look at Amazon, AMZN. Now, let me get rid of this highlighted color. It's got an island gap reversal is what that is. No, it's not. It didn't gap back down. Never mind. But it looked like an island gap reversal. But we're going to clear. No, don't clear everything. Just want to remove that color. There we go. All right, so what do we see here? Well, on Amazon, we see a stock rallied up, came down. It's really been bouncing around following a kind of a diagonal trend line, right? Hold on real quick. There's a late comment that came in on Adobe. Breaks a key level of 300 sell, 300 put. Let me go back real quick and just look at this ADBE. I missed that comment. So if it breaks 300, level 300, there's 300 really isn't a level, according to, some past levels of support or resistance. And so 316, and maybe you're mentioning 316, the idea would be to enter some sort of a bearish, we're looking for a bounce off of 316, and when and if it does, at that point, we'd be looking for anything of a bearish type play, which could be, buy a put, sell a call vertical. We could do a long, put vertical. There's different things that could be played, but it'd be looking to be bearish on that. And I wouldn't look to be bullish on that immediately either, because it's a long-term downtrend that has, so looking for maybe some higher highs, and we'll talk about that in another one coming up. So hopefully that answers that question. So sorry I missed that one a little bit late, but I wanted to make sure we get to that. All right, so looking at Amazon, though, you can see the diagonal trend line that I drew in. Now, one thing I just want to stress about trend lines is from a technical standpoint, some people consider them kind of secondary to horizontal. Horizontal, there's only one way to draw it, right? Meaning you can't really manipulate it. It's just you line up a high and it has to match up with another high or not. That's it. You just kind of come over here and say, okay, does it line up with something? Does that line up with something? Where a diagonal, we can draw a diagonal line anywhere. You can draw a diagonal line between any 2 points on Earth. We can draw a line there, we can draw a line here, we can draw a line over here. It really doesn't matter. So to make it really mean anything, we have to have 3 touches. 3 touches, very, very important to understand on those. Without 3 touches, it's just connecting 2 dots. And 2 dots are easy to connect. Any 2 dots, easy to connect. But to get a third one, well, that takes a little bit more lining up, right? So keep pointing, and we have that. We have 1, we have 2, we have 3, we even have 4 on Adobe. And so let's go in and look at placing a potential trade as we're looking for this to bounce up, rally off support, and continue higher from there, okay? All right, so let's get rid of these. Let's go check that out. And where was that support? Around 226-ish, 225, 226, somewhere in that ballpark is what we're looking at. So let's go over to the trade tab and see what we have. Well, I like to look at the typical weeklies to start off. Generally speaking, they most often have the most volume, therefore they have the tightest bid-ask spreads. It's not always the case, but that just tends to be the rule. So I want to go there first. And so let's look at this. And so I'm going to go out 26 days, or February 26th, what I'm saying, February 20th, 26. Got to get used to new year. 29 days is what we're looking at. And so maybe a little bit on the short end is still probably okay, where we can find some. I mean, just generally speaking, when you get close to about 20-ish days, it becomes difficult to find the premium at times because there's just not enough time. But at 29, we're probably still okay. So let's take a look at that one and just see where we're at. All right, so rolling up sleeves here, looking to get into this. I'm going to start off with the delta, and we've talked about using the delta approximation for probabilities, and weekly or monthly. February 20th is monthly. The typical monthly. The question is, what about why is this the monthly or weekly? Typically speaking, the monthly is the one I'll go to just as a default to look at, versus like, hey, why don't you go to the 20th, the 13th, which is 22 days away, or why not this one, the 27th? And this one's a pretty heavily traded stock, so I don't know if it's going to show, but like if we look at this, these are still pretty tight. I mean, we could go out. These are still pretty tight, but quite often when you look at them again and again, and something maybe not quite as heavily traded, then the ones that are on the weeklies oftentimes will not be quite as tight on that bid-ask spread as the weeklies. But I mean, we could go out another 7 days if we want to on this one, because they are still pretty tight. In fact, in this case, depending on where we're looking, 55, yeah, they're both pretty tight. But let's look at this one, because if we can get it quicker, then we will, right? So let's look at this has 2.5 wide spread. So we want to be around that 226. Let's actually look to sell that 227.5. So I'm going to click on the bid there, and I'm going to hold down the control key and hit the ask on the 225. And so we'll create a $2.5 wide spread. What are we getting that? Well, we're getting 90 cents on that. All right. So if we look at that trade, let me pull this up just a little bit and clear this out. So if we have 250 and $2.50 minus, well, let's go to back 90. I like that easy number to work with, right? So $2.50 minus the 90 cents is going to give us $1.60, right? And so we have the 90 cents of our profit potential divided by the $1.60 on the risk side, and the ratio there is about 56%. And so it's actually, fairly decent ratio risk reward on that. Now there is, I know there is earnings coming up on that, and so I'll come back and talk about that in just a second. But so with the credit fairly good, we're looking a short time till expiration. And here's the other thing, I want to go back and look at the implied volatility, but let's continue on with this, and let's place a trade on this one. So we have, what was the risk on that? The risk on this was 160, right? $160. So let's take our $1,000 that we've been doing as risk in the class and divide that by the 160 that we're taking on this trade, and that's going to give us about 6 contracts that we're going to be able to do on that one. So let's drop this down to 6 contracts, and we'll send that off with a 90 cent to look to get filled there. And we have a potential max profit of 540 with a max loss of 960. No red notices to be concerned about, so we'll go ahead and send that off. All right. The calculation again, I'm not sure which calculation you're talking about, but basically there's just a couple calculations we went over, right? One of them was the width of the spread is $2.50, right? And we received 90-cent credit. That gives us $1.60 worth of risk. And then we divided the 90-cent reward by the $1.60, and that gave us that 56% risk reward ratio. And then the other one we did, the last one we did, was we took $1,000 of risk and we divided that by the 160. I shouldn't put a period in there. $160, and that gave us the 6.25 contracts. So we had our risk in place. All right. Myron, hopefully that looks the one with the bid-ask spread. The bid-ask spread. Hopefully that one was answered. I'm not sure which one you're asking for the bid-ask spread. Okay, let's go back over to the chart and let's talk about a few things. Let me add to this. I'm going to come up to the beaker on this. I'm going to click on the beaker and bring up the implied volatility and go IMP. And I'll bring up implied volatility. And that to that, so add the selected, apply. Where's the 90 coming from and where's the 160 coming from? So we did the trade itself. So to answer that question, the trade itself was we had 2 strikes, right? So we sold, not at 255. Hold on, it was 227.50, if I recall right. Right? Yeah, 225, 227.50. And so those are our 2 strike prices. So we have the 227.50 and the 225. So what are each of these? This is the one we sold, right? We sold this one. We're looking to sell it if it will go through. And then this is the one we bought. So we have those 2 different strike prices. So we did 6 contracts on each. The difference between those 2 strikes is $2.50. So that's where we get $2.50. And then the credit that it said we could receive on that, and the credit we bring in, is 90 cents. And so if this is the width, which is actually, kind of the risk is, because if it goes south, right? If it goes south, we'd lose that $2.50. However, we'd keep 90-cent credit, and that's what came up with the $1.60 risk. There's a difference between, it looks like it just got filled. There we go. Yep, there it is. And so hopefully that helps you understand where do we come up with the 90. That was the credit. And then we took that from the difference between the strike prices, and that gave us $1.60. Okay, cool. You're welcome. All right, let's jump back over to the chart now. And I wanted to bring up, I have it on twice now. We don't need implied volatility on there twice. Let me go ahead and remove one of these. And so looking at the implied volatility, so this is something that it's a little bit elevated, which is why we're getting a pretty good premium. So here's the deal though. If the stock can go up, yes, it does have earnings coming up in about a week and a half, okay? But look, if the stock will bounce up and run up, oftentimes, even though earnings is coming up, it could even drift lower. It may go a little bit sideways to lower, but we could possibly even have this work in our favor with the stock price working in our favor. And so that could kind of help amplify the deterioration of the value, which would allow us to buy it back. And so we'll have to keep an eye on this one next week. We'll talk about it next week and see if there's any modifications we need to make before that coming up. All right. So that's Amazon. I want to get a few more in. Let's see what else we can do here. Let's pull up Citigroup. Let's go see. All right. So Citigroup, now Citigroup just had earnings. And so I thought this was interesting. Look at it. Then here's the thing, like this one really doesn't move much. I mean, well, besides that, that, enormous move back there. But generally speaking, the range that we see on the implied volatility, and I don't want Fibonacci on that. I just need a normal horizontal, I mean, I don't even know where to draw this. There's hardly a solid low and high, but generally speaking, I mean, a lot of the action is kind of like within this area. It's not a very wide, it doesn't move a whole lot. And so there's not a lot of bleed off or they'll ramp up on these options. So they don't get fairly inflated, but they also don't shrink down. Maybe compared to others that can have a much wider range. And so it's something to always keep in mind when you're thinking about implied volatility. And it's like, typically speaking, it's always nice to look to sell, when it's high, right? Sell when implied volatility is up here, and then, buy when it's lower, right? That's kind of general rule of thumb. But the range can also play a big role in that. I mean, if you're looking at a range of, even in this case, we're talking almost like 30 to, and I push it up there to 38, maybe it's more like 35 or something. It's not a very big range compared to maybe we pull up another one that's going to be, maybe 25 to 55. In that case, being up at resistance, or should I say a high point in implied volatility, would be much more inflated. Those options could be much more inflated, relative to the low spot. And so you can see a lot more movement. The implied volatility would generally have a much more impactful movement on the options on that stock than it would on this stock. So lots of things that can impact it. But so sometimes when we see something like this, we may think, hey, you know what, it just may not be as impactful. It's like, it's probably not going to go real high and it's probably not going to drop down a lot. All right. So really it comes down to, okay, well, what about, the stock? What's going to happen with the stock? And what we've seen is it's been running up, it's been pulling back. I wonder if we can even throw some fibs on this one, see what happens. Let's try that. Let's take it from the support level. It's this is the last time it had like a horizontal support before it took off. It did run here and then it climbed a little bit higher right in there. And let's move this down so now we can see what happened with that. And I want to make sure we get at least this one in. I wanted to, if not, I'll show you the other ones where I was going to look at as well. But you can see it's coming down. It's sitting at this little level support here. And we can see the momentum starting to swing back up. It's not positive yet. What this means, when you see the MACD histogram starting to roll up like that, it means it's still net negative momentum, but it's slowing. It's like less negative momentum, right? It's like the negativity is slowing down, and it's not totally positive yet, but it's less negative. And so when we see that kind of rolling up, it does indicate, it's the way to say more bullishness coming in. And we also see a level of support holding. And so let's go out and see what we can do with this one. Somewhere around, we got this 113, 114, 113 ballpark area. So let's see what Citigroup has to offer us as far as potential trades. And again, I like to look at that typical monthly expiration cycle versus the weekly. It's funny as I say this, this is a little bit better example on it, right? Like 171 versus 206, if we're looking at the 110, 150 versus 161, 370, if we look at the 116, 370 versus the 425, what do we have there? About 75 cents. We have 116. Well, that one doesn't help us out. And it can vary about which ones have more activity on them. But just generally speaking, usually at the money, it will be those near the typical monthly cycle, where it expires the third Friday. So let's see, we were looking to sell somewhere around 113, 112, maybe even 112, right? So let's see what kind of premiums we can get with this. And let's go like too wide on, are we going to get much on this? That one has changed quite a bit since I last looked. So we got a too wide spread. If we can get 50 cents out of this, now this is going to be a little bit tighter. Okay. If we can get, so the difference between the strikes is $2. So let's walk through all that math together. We got $2. And so basically this is, if I were just to kind of back out and just say, here's the risk of the trade, where we're selling this 112. And so if it goes down, we have the right to buy the stock and then sell it we have the right, if it goes down, we're going to have to be, it's actually going to be put to us, which is going to be the issue. And we can lose the difference. Then we can put someone else, we're going to lose the difference between that. So our risk is $2. But if we keep 50 cents over here, then that actually makes our risk, $1.50 on that trade. So you can do the math pretty easily. And it's like a 25%, like if you do dollar, or no, it's a little bit higher than that, isn't it? About 33. 50 divided by 150 is 33. So we got 33% return on risk here. And so So I was looking for that to be about 30% or higher. And there's not a hard and fast rule on this because it also depends on how much time there is to expiration, all kinds of different things. But let's go with this one. What's our delta on that, by the way? Delta's 33. Well, got a lot of 33s in here. So let's place a trade on this one as well. And with this one, we have that risk of $1.50. So that's going to be pretty much the same as the other one, isn't it? We had $1.60 on the other one. So divide that by $1.50, and we have 60 or 6.66. We got this 3.33 all over, and we have 6.66. When we look at how many contracts to do. So we'll just round that down to 6, and we'll do 6 contracts on that. And we'll go ahead and confirm and send. And again, looking to get $300 profit, $900 of risk. And then, really looking just to kind of hold this area and just kind of bounce and drift higher. And if it does that over time, then, we'll see how this one plays out. We'll talk about this one next week as well. Gosh, I wanted to go through a couple more. I was hoping to place a couple more trades on this. I was looking at, we've done Tesla several times, but let me just leave these with you as kind of a food for thought, right? And Tesla, I have some Fibonacci's. Let me back out just a little bit. So I have some Fibonacci's that ran from here to here, and it came back, and this became a support level in here. And so I could really remove those and just draw a horizontal support level, because we've seen this multiple times. Let me just do this and remove that to kind of clean it up. But you can see how it's bouncing off a support level. It does have the earnings, and that is something that does coming up. That was maybe a little bit tighter. And then Google, whoops, let me get this over here, GOOGL. Upward trend. I mean, this one, you can just see it bouncing off this moving average again and again and again and again. And there's the bounce. Now, this one gives us a little bit more time before that earnings announcement. And this is the thing that happens. I mean, you get into that earnings announcement time, and sometimes you have to play a little bit different. We have to say, you know what, I'm going to just kind of look to take this one off. And this one is one, let me end with this one. Because this one, overall downtrend, right? Overall downtrend. And if we look at this, it's making these highs, lows, high, low, high, low. So it's making lower lows, lower highs. The moving average is dropping down. There's all kinds of things indicating, obviously, it was in a downtrend. But what do we see here? Because that last high was right there. Boom. I kind of draw a straight line. Well, you get the picture. It broke above it, right? And so this is a potential breakout, a change in direction on that trend. It's going to be interesting to see, will this come back up and make a higher low at some point? So we'll keep an eye on that one as well to see if that does, in fact. And some people will take that play. Sometimes it's a little more aggressive, but they'll take that play as it kind of breaks out of that, the lower low, lower highs, right? Which again occurred, let me just draw it with the tools here, which occurred when it broke above this spot right there. And so that's, kind of step number 1. Step number 2 would be a higher low, which could be somewhere in here. And then obviously breaks that again would be 0.3 to have a full trend reversal, but it's giving inclinations already from a technical standpoint. So a couple things to keep an eye on. Got a couple trades in there, a couple things to think about. Hopefully next Wednesday, the market will cooperate a little bit better. So we'll follow up on all 3 positions that we have going on at that point, and we'll look to even add some more. I just want to make sure I didn't miss anything. I think I got it. Let's see. I think. Why do I keep seeing Taco trade at cash open? Let's see. I'm with you, Bruce. Thank you for getting that playlist in there. Thank you, Cameron. Cameron's so great. He does a terrific job on that chat. I really appreciate it. So it looks like we're good. We'll call it a wrap. Thank you for joining me, and please like and subscribe. Do that. If you haven't subscribed, please do that. But another thing I want you to do is please post comments between now and next week. It's a great way for me to connect with you. I read every single one of those comments. So please come into this class when it's posted. Post your questions, post your comments. I can respond there. If you want me to cover things in more depth in the next class, I can look to see if I can work those into the curriculum that we're going to cover in that day. And so it's a great way to communicate with me. So please, please, please post comments in there. But until then, have a great week, and I'll see you next time. All right, take care.